Welcome to the BS Banking Show, Mr. Misra. My first question is, how will the HDFC Bank HDFC Limited merger play out on the home loan business?
So the merger is definitely very exciting for the home loan industry because it is a merger of two giant companies. We expect that HDFC Bank has a very ambitious DNA, and we now expect that to translate into higher appetite for market share because HDFC has been in the number 2 spot for the last few years. So we expect the race for the top spot between SBI and HDFC Bank now to hot up. But what this will also mean is that the banking sector will acquire a disproportionate share of the mortgage industry. As of now, there were only two housing finance companies, HDFC Limited and LIC Housing, with a balance sheet of greater than 1 lakh crores. So now nearly 70 to 75% of originations for the housing loan segment will be with the banks. Now, what this means is most banks typically tend to focus on the top tier cities, on loans greater than 20, 25 lakhs and so on. Housing finance companies, especially affordable housing finance companies, they play a very critical role in the larger housing ecosystem by going to unbanked geographies, by going to unbanked customers, deeper geographies, unbanked customers, and so on. So I believe that for the affordable housing focus to kind of sharpen, it is imperative that some of the housing finance companies now quickly build scale.
Are you then suggesting we need more HFC players?
We may not need more HFC players. In the last 5 to 7 years, nearly we have more than 100 registered HFCs. What we need is more HFC players with scale. If you see the current HFCs, then many large industrial houses have HFCs which have been operational for the last several years. Second, almost all large private equity players have housing finance investments. So capital for housing finance companies will not be a challenge in the immediate future. What is required is scale. And especially in the housing finance companies that are backed by large industrial houses, the access to capital along with the access to parent company rating is an added advantage. So they are even able to borrow cheap. So what we will need is a couple of housing finance companies to step in and build scale and quickly weave their way into the top 5-6 slot. Some of this is a consequence of DHFL and India Bulls slowing down. But now we see that the DHFL part, at least their new owners are very ambitious, aggressive, and systematic in their growth plans. We will need a couple of other such housing finance companies to step up on the ambition part.
Yeah, but even when HDFC Limited was around, it was an outlier in terms of size. Why didn't the other HFCs gain in size? How do you explain that?
No, the other HFCs did not gain in scale. If you look at the scenario, say 5 years back, we had 4 or 5 housing finance companies that were large scale. You had HDFC Limited, we had LIC Housing, we also had DHFL, we had India Bulls, we had PNB Housing. All of them were originating upwards of 1,000, 2,000 crores a month. What has happened is that those with access to low cost of funds and with the liquidity challenges that came post-COVID, the larger players got a disproportionate advantage. So now is the time for the smaller to mid-sized players to rebuild and scale.
Are you raising a question on the HFC model itself?
No, I'm not raising a question on the HFC model. I'm saying that it is imperative for the HFCs to now build scale because the model has been proven in the past. If you even look at DHFL's model when they were building a retail book, the retail book was not really troublesome. So HFCs have demonstrated that it is possible to build a large book along with affordable lending. Somewhere in the aftermath of COVID, we believe that building scale is taking time. Self-employed businesses are facing the struggle, and there has been an increased propensity to lend to salaried borrowers. If you look at all the large players, if you look at State Bank, if you look at HDFC Limited, the proportion of salaried borrowers in their origination mix is very high. And somewhere, we believe that we can play an important role in this. If you see our portfolio of 20,000 crores, we have now nearly 35% of our origination now is in rural and semi-urban areas. I believe that if we look at the housing finance industry for the next 5 years, currently the industry is at 33 lakh crores. It is expected to go to 50 lakh crores by FY 47. If you see the next 20 years of growth, I believe the first thing has to be that public sector banks have to get more focused towards affordable lending. Public sector banks currently contribute 40% of the housing finance origination, out of which if you take away State Bank of India, the others put together are about 20%. But all of them are operating in the ticket size of 25 to 35 lakhs. So for the industry to grow and for the dependence to go away from 4 or 5 players, and more importantly to drive financial inclusion, step one has to be public sector banks have to go into deeper geographies and do more inclusive lending. Second, housing finance companies, now that they have reasonable access to capital, should be demonstrating ambition to build scale, because it has been shown in the past. So the need to build scale is imperative. We also believe that once the securitization committee recommendations and a couple of other initiatives that the regulator is taking to promote securitization take place, it will help smaller housing finance companies operate with greater ease, because they are the ones who will feel the pinch to capital. So once we have securitization back as a vehicle of liquidity, I think that will also help. Fourth is for the housing finance companies, co-lending initiatives are very encouraging, but everyone has so far taken only baby steps. Once we see some co-lending taking shape in a more fruitful manner, I think that will help the industry.
What is the scale of your ambitions in the mortgage guarantee business?
See, we have currently guaranteed about 20,000 crores. We expect to grow 40 to 50% in the next for the next 3 to 4 years. After which our growth could taper off to say 20-25%. We wish to continue our journey towards promoting financial inclusion. Our ticket size was 26 lakhs 4 years back. It is now 19 lakhs. Our penetration is growing in the rural and semi-urban areas. We wish to penetrate further into deeper geographies. For the next 2 years, our largest priority is to deepen our penetration in public sector banks. We already have a partnership with State Bank of India that we are rolling out. We are at advanced discussions with 3 other public sector banks. LIC Housing as a public sector entity is already our largest lending partner. So we believe there is enough scope and play for us to add value for the public sector banks to deepen penetration and focus on affordable housing. At the same time, we are working with a few dedicated housing finance companies, again, largely to drive affordable lending, because that is where we believe our sweet spot lies. I think a portfolio of 1 lakh crores is where we will get to in the next 5 to 6 years. But more importantly, we would want to play a significant role in the growth of housing finance as a contributor to GDP. It is still hovering in that 10 to 11%. And even now, nearly 50% of all housing finance originations happen in the top 5 or 6 cities. So we would want to play a greater role in deepening financial inclusion. Secondly, most of the innovation has happened on the unsecured lending. Secured lending practices still remain, fairly archaic, I would say, and the changes have not been very substantial. We believe that given the number of people for whom the housing loan is their first entry into the financial system, and therefore there is no bureau support in terms of defining their credibility, we are on the verge of rolling out a score which will be specific to housing loans, and where we will draw upon our experience with nearly 23 to 24 lending partners. We have access to application data, application to portfolio data. More importantly, we have the unique experience of access to claims data. So we are currently piloting a score, which will be the IMGC proprietary score, which will be largely for new to credit customers where a bureau score is not available. And we believe that will provide the much needed automation and, so to speak, a structured risk appetite model for the affordable housing.
How does all these compare to initiatives in other countries?
So in many countries, a mortgage guarantee is a compulsory product. If you look at Canada, it is a compulsory product. If you look at the United States, any loan greater than 80% LTV, it is a compulsory product. In India, it is not a compulsory product because our loan to value ratios tend to be lower, and the borrower approach to a housing loan is very different. And it is next, home loan repayment is probably next only to school fees in the hierarchy of repayments. But in many countries, it is a mandatory product. In some other countries, it is a excellent credit enhancement substitute in securitization. For example, many securitization transactions require the originator to keep a cash collateral. a guarantee can act as a substitute for the cash collateral as credit enhancement because they're performing the same function, and therefore it makes the system more frictionless. So many of these practices are already adopted in the Western economies, but I can say that more and more lenders are seeing the value of expanding their risk box with mortgage guarantee. Second is with Ind AS coming in and expected credit losses, people moving to the ECL model as opposed to the earlier mandated model of provisions. The ECL on a guaranteed, our guarantee is irrevocable and unconditional. So technically, for a lending institution, we cover the expected credit loss on the guaranteed portion is actually zero. So even if they wish to keep some counterparty risk, it will really help the P&L, especially of smaller housing finance companies, when they take a guarantee, because they need to provide less because we are keeping capital and our guarantee is unconditional, irrevocable. We have paid every single claim that has come so far, so our credibility is established. And we believe that as the Ind AS regime becomes more and more prevalent, people will see value in mortgage guarantees that go beyond risk expansion.
Mr. Misra, it was wonderful having you on the BS Banking Show. We look forward to having you again sometime soon.
Thank you, Raghu. Always a pleasure talking to you.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.